Good morning, and welcome to today's webcast, Retail. Get your excess inventory back on track. Before I begin, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Loren Den-Herder, Frank Kaufman, and Brian Favorat. Loren is a firm leader of business intelligence and corporate performance management. He helps businesses improve their processes and become more efficient and make better decisions. Frank has been directly involved in the retail industry since starting at Moss Adams in 1983, with a focus on helping clients to grow and achieve their goals. Frank identifies impactful industry trends, develops relative strategic plans, and assesses plan implementation. Brian has over 9 years of experience selecting, maintaining, and deploying financial system solutions and has provided management consulting services to public, private, and non-for-profit clients. With that, I'll turn it over to you, Frank, to get us started.
Thank you, and welcome everybody. As you can see, here are the topics that we're going to be covering today. It looks like we have representation in the audience across the coast, from West Coast to East Coast and everywhere in between. So hopefully my background is inspiring. Looks like a little sunshine for those of you who are not experiencing that. Let's look at where our big challenges with retail today. I will say, as the intro said, I've been doing this quite some time. I have never seen an inventory market that experienced such a backup. And so I thought it'd be helpful for us to kind of look at, well, how did we get here? And some of this might be painful for you, but bear with me. There's a reason to go through this. So first off, predictability got turned on its ear a little bit on the supply chain in the last year and a half. Goods couldn't get through, couldn't get containers. And so it sort of fostered this environment where we were missing sales. And so, well, what are we going to do? We need to make sure we get our inventory in quicker. Okay, well, that created a big demand on containers. That plus the limits that were on the tractors here in the U.S. and the coast to be able to pull those containers off the ships led to just a complete backup. Even though goods weren't flowing through to the retailer, they were here or offshore, very near, maybe within a mile of shore. And so, as many of you experienced, if you were importing a container that cost maybe $2,000 to get here from Asia, got as high as $30,000 last year. And so there's a lot of competing things going on at the same time. One of the I guess the positives as far as retail spending was there's a lot of stimulus dollars being put in to the economy by the government, and it was found money, and there was spending that was happening quite regularly and rampant. And so we had this good growth going on, and if we look at about in the middle of 2022, what happened was the comfort level of the public going back into the stores got to where it needed to be, I'll say, and people started going back to the stores, which is a good thing. However, a lot of the e-com entities had been projecting revenue based on these incredible growth rates. And even though e-com is still growing, you'll hear a lot of people talk about how the e-com channel slowed down dramatically in the second half of last year. And it did slow down relative to what it had been, but it's still growing. So it made all this very, very difficult to decide where we're going to be, what inventory do I need to buy, and it's just been a very challenging environment for all of us. And the other things are you have this kind of unusual financial environment where everybody's talking about the recession. Are we in a recession? At the same time, the interest rates keep going up, trying to stop inflation. So again, a bunch of conflicting information, and how are you going to make those decisions? So basically, the traditional planning and judgment calls, they're just not really working. So you had to think a little bit differently about what your strategy is. And so when people were backed up with inventory, and I think it's starting to get much better now from most of the people I chat with, they're either getting out of it or pretty close, but think they're going to be out sometime, I'll say June, July-ish, right? But what did that create? That created, first of all, why didn't we get out by the holidays as we usually do? Well, when you're done with your holiday shipping, you didn't have the channels for the closeouts because they were full, right? Then the financing on that inventory, let's say if you have normal trade terms and if you have a good structure in your company, you can get your vendors to supply you with what you need to grow. But when the inventory backs up, the cash flow demands get much tighter, and we had to rely on some of the banks to help out. One of the things I've never seen before in my career, and I saw it this year with one of the major retailers, was that there was a different level of recognition of how important your suppliers are. And what I mean by that was, historically, if the retailer were a bit over inventoried, you work on deliveries, maybe push things out, substitute product, somehow find a way to work it out, and occasionally cancellations. Well, what we were seeing this year was some of actually one in particular large retailer, is they would actually cancel the goods but pay for them. And they were usually at maybe a 10 or 15% discount, but they literally were not receiving the goods and paying for them. And I thought that was amazing. Sometimes that retailer would ask to have that product donated. But the implication is, wow, we have a key supplier here. We can't crush them. We're going to support them for the long term. And it was pretty amazing. But anyhow, long story short, there's a lot of different things that were going on, maybe first. And so what we did come away with is, certainly as the decision making has advanced much more rapidly over the last 5 to 10 years, it is even faster now. You have to be able to communicate within your organization, and you have to do that when a lot of our organizations are now remote. You don't walk into somebody's office next door and show them a schedule and say, hey, take a look at it, because that next door might be at somebody's house. It might be in a different state. So the systems have to be fast, and it has to be one source of truth. So that's what we're going to address today, is how we get to a point where your organization is talking to one source of truth from all touch points. And so, but we do have polling questions, so we'd like you, if you could, to give us a little feedback here. And how quickly do you think your decisions are being evaluated in your planning decisions? So if you could, I see everybody already starting in, so we'll give it a little bit of time. so that you guys can all answer.
Yeah, so what we see here, Frank, in our travels with our clients is there's quite a range of answers to this, although typically we see there's a lot of work that happens in spreadsheets. The plural part of that, spreadsheets. It's so there's always a question about just what version are we on, which spreadsheet are we using, and does that translate from one to the other, and are there embedded errors? You know how it goes with spreadsheets. I don't know if that's what you see on your side as well.
Yeah, I mean, Loren, because you have, like I said, everything's interconnected. So you have, if their inventory is blossomed, I'll say, right, then that creates financing needs. Well, how can you go to the bank and project if you're not, if finance isn't speaking with production and sales, right? And so that's exactly the case. And everybody has their own little tools a lot of times. And that's where I'm talking about this one source of truth. It's very frustrating. And if you're an organization of half a dozen people, okay, maybe you can do that. But even if you're 20 people, it gets to a point where it's cumbersome, and the decisions involve lots of zeros behind them. So you really need to try to get to this one source of truth. So
Yeah,
give it just a couple more seconds. Oh, here we go.
Yeah, so we can take a look at this here. Looks like, yeah, this kind of represents what we see is that there's a lot of work in spreadsheets. There is a movement towards this kind of a comprehensive planning solution, which is what we'll be talking about here today. Is like, how does that make a difference between spreadsheets and an overall solution? And then we also see that there are still situations where, as you're making, your scenarios put together, it ends up being not necessarily comprehensive across the overall organization, and it just helps to have that pulled together. So what we do want to do is just talk a little bit about automated planning and how does that really help out. So what I'd like to do is just start on the right side of this, and there is this statistic that we see out there where CEOs really do want their organization to be data-driven. And the question is, like, how do you actually make that happen? And because of that question, what we do see is that, of the 83% that would like to be data-driven and are aware of the need of that, only 30% really think that they are. And so how do you close that gap? And that's a lot of the work that we do, is to help to close that gap of where you want to be more information driven, but how do you get there? So when we're talking about data analytics and looking at embedding information in the business process, that's really where we find the key. So if I start a sentence with having things that are information driven or data driven analytics, then kind of right away there's a little bit of disconnect, like how do you actually get that done? And so what we have found is it's really about having information embedded in the business process, and then that's where it kind of brings it to light, where if the person in the business process has the information they need at hand with what they're doing, then that makes the organization more data-driven. And so when we talk about just data analytics by itself, it's a little bit cart before the horse. So as an illustration of that, just looking at on the left-hand side here, if you have a decision scenario input and it goes into a central planning solution, then everybody, so there's representation here of different departments across the organization. That information then flows into all parts of the organization, and everybody can then work with and act on those decision scenario inputs. And what you get out of that process is a full impact evaluation, meaning you can look across the organization, both at operations and full financial impact in terms of income statement, the balance sheet, the cash flows, and play out that scenario and see what would that plan produce. What is really helpful here is because it's scenario planning, you can have multiple different scenarios going into a central planning solution and be able to then evaluate if you were to choose one direction, what is the likely outcome of that? If you choose a different direction, what is a likely outcome of that? And have the whole organization working in concert with that. So just as a comparison, so what is the value of that? What is the value of having that information at your fingertips? And those few bullet points down below are there to kind of highlight that value. And one is if you're in a set of complicated spreadsheets, just the logistics of dealing with them tend to delay the process. And that delay actually gets a bit costly. Part of the delay can be because it's just a logistics of the spreadsheet, or it could be because you have multiple scenarios and the complexity just went through the roof. But what a delay ends up costing in terms of the business is what Frank was talking about, where it takes time away from the supply chain. And while it looks like you have lead time, every day counts in that supply chain. And so you want to get through your planning scenarios and optimize that as quickly as you can so you can get then into operating with what that decision scenario is really telling you. Also getting real-time information and comparing that to the plan. That's another really important part of being able to see how are things shaping up as to how we plan to shape them up, and then be able to make decisions in real time as they're happening. So with that in mind, it's like, how do you see that information? It's so, dashboards is a great way to put it in context. And when we're talking about dashboards, we'd like to have and structure dashboards that are really focused on the individual decision making and the individual business process. The business process might be a boardroom, but the business process might also be as focused as somebody in purchasing or in marketing, and just seeing where are things going. So it gives context to the decision, and then you can call out particular things on that dashboard and drill into it and say, okay, here is something that I'm seeing where our plan is. I see the trend of where the actuals are going. It would be good to get out in front and make a decision while it's, quote, in the decision-making window. So in the period, don't wait till the end of the period and when you're beyond it and now you can't make a change to that, but rather backing it up so that you're seeing things on a very, very frequent basis and being able to act as the trend begins to develop. What we like to say about that is about changing the question across the organization from what has happened to what is happening. And there is huge value in being out in front of that. In fact, what we hear from CFOs over and over again is if they have their budget managers and they have their department managers making one good decision a year, it pays for the effort of putting in a solution to manage that. Everything else is gravy on top of that. So another polling question here is just, what tools are you using to plan? So we see, again, spreadsheets, we see automated planning solutions. There are some other tools out there as well. And then there are organizations too that are just, haven't really expanded into overall annual budgets and rolling forecast alike. So it'd be good just to see some input of what is being used in your organization.
Loren, while people are addressing this question, I don't think I've ever seen alignment as perfect as what we had on the first question, which was there were 17% of the respondents that said, we are running our company with an integrated data-driven, solution, and 83% were we could do better. And the next slide you popped up was the fact that the CEOs 83% of CEOs want to move their business to more data-driven solutions. So, I mean, I think what we're getting to is speed and really quick communication. And it's great to see that people are aligned that way. I'm not sure everybody is on board with that through an organization to talk about that, but it was a pretty impressive data point to me that everybody sees that this is an opportunity.
Yeah, and what we tend to see as organizations take on these planning solutions is there's, a variety of people that embrace them. And so if it's, driven by leadership, then there are champions in departments that are kind of, quote, into it. And as they find success in their department, that success breeds success and it guides others through it as well. And so it's getting that engagement is what gets people to changing the question from what has happened to what is happening. And it's actually very, very powerful. So, yeah, so this very much aligns with the prior question where spreadsheets are really the dominant tool at hand. And so all your organizations that are using those spreadsheets know what I'm talking about when it comes to what if you get your planning complex multiple scenarios, then the timing of that really does get pretty interesting. So what we'd like to do is just lay the groundwork here for what are we going to see in terms of a demonstration of how does this solution work. So there's a Workday has a solution called adaptive planning. And we want to just give you an idea of what does this solution look like and how does it answer this question that we've put up here. So how does it inform the overall organization? So just for purposes of the demo, we'll take and we'll have the input of, what is the decision that's being made? What is the scenario being evaluated? How does that present itself into the organization? And then we'll drill into one particular department in purchasing and how it's responding to an executive decision about let's set the gross margin, to run this business, to have the cash outcomes that we need. We need a particular gross margin, and then purchasing will have information to work with that. So what you'll see as we go through this is that, the timing of information and the availability of information is just really critical to how you are seeing that success in the business. How quickly can you respond to trends that are growing? And then also what this solution here is going to do is just, give you an idea of how can the information made in one area and that it has an overall financial picture with it, get right down to an individual user, and that user be able to do their job, and what they do on their piece feeds right back into the equation, and then you see that on the overall results. And then lastly, what's super important here is you can make a plan. That plan becomes the guardrails for the business, but then you take that plan and see the actuals come in on a regular basis and how does that differ, because that right away is going to lead you to a place where you need to make decisions about what's really happening on the ground at the time. So with that, we want to jump right into the Workday Adaptive Planning solution, do a demonstration here, and Brian's going to lead us through that.
Perfect. Thank you, Loren, for that. Queued up. All right. All right. So this is a Workday Adaptive Planning tool that Loren has mentioned. Here, we're on a couple dashboard screens within the tool. And just to set the stage again, we're assuming at this point that marketing sales has provided their projections for this demo company. Finance is now working with operations to optimize inventory levels. And once the base assumptions are applied on both the sell side and buy side, management can review some opportunities to potentially enhance the margin here. Now I'm going to pivot over to our inventory dashboard. Here we have a few graphs that provide some different snapshots of the business. So at a given point, we can look at available inventory by product, category, available inventory by location. So some inventory purchase information, and also our inventory balance with a weekly outlook. These dashboards can be used by both analysts and executives to answer some questions about the business. So stepping into the role of an analyst here, I'll demonstrate how to identify issues or inefficiencies by drilling through to the dashboards. So on our inventory balance piece here, you can hover over the different weeks and we can see different information components about what our ending inventory looks like. So if we click into the last period, the final period, we have some different segmentation about that data point. So what I'm going to do here is drill into product category. And it's sort of as I expected here, based on some of the graphs you may have seen on the previous screen. I apologize if there's a slight delay. Product category B1, we're seeing a lot of excess inventory at the end of the year, more so than all of the other products. So if I want to learn some more information about that, I continue to drill deeper to answer some of my own questions here. So at this point, what I'm going to do is drill through some different components of the business. And what I'm really looking to find is where this exists. All right, so drilling all the way down to the bottom, what I've discovered here is with that particular product category, we're really overweight in the US East region. And this could be for a variety of reasons. So if I'm just jumping in here, I'm trying to get kind of a high level understanding of where am I seeing this particular problem. And now that I've kind of identified this inefficiency, what we can utilize is other components of the tool to help drill in and understand a little bit more about what we're seeing here, what's going on, and if there's anything that we can do to move the needle to make this a bit more effective in terms of how we might be able to manage that cash in other parts of the business. So going on to my next tab here. So this is a sheet within Adaptive. It provides some context as it pertains to the inventory. What's really neat, as Loren and Frank had mentioned about tools such as Adaptive, is you can integrate other areas within the tool into different pieces of the sheet so that when sales and marketing is entering their information, that information just comes directly into here. So really what we're doing is we're having the ability to evaluate our inventory by looking at both our actuals and our plan information. So I have all of this information right at my fingertips at a very simple, easy to use sheet. So kind of going back to our original problem there, we saw that in Sales East for product category B1, we were particularly overweight. We were excess in our inventory. So we had a lot of available inventory at the end of the year. Perhaps we a little bit beyond where we might see a certain threshold. So in this model, what you're seeing is on a weekly basis. We have different numbers that can be planned. What I'm going to do is scroll to the right here and allow me to blow this up for everybody so it's a little bit easier to see on your side. All right, so scrolling towards to the end of the year, what I can see here, try to go too slow not to give anybody some motion sickness, is our ending balance for this particular category at this region is 144,163. And to help provide some context to that, we have the dollar numbers below and with the unit figures above. So 2421 units for this particular region and product category. That doesn't provide us a whole bunch of insight by itself. But if we scroll back to the left, as an analyst, I might be curious to know, okay, well, how are we doing in the previous year? Where did we end with actuals? So within the same sheet for the same data segment here, we have 815 ending at the previous year. So what that tells me is perhaps we overbought or we overpurchased into this particular product category for a variety, it could be any number of reasons, but definitely that we are overbought here in purchase units going into the future as compared to previous periods. That might be an area to evaluate. So one thing I might try to do here before I start adjusting numbers is I'm curious to know, okay, with product category B1, how are we doing in other regions? So I might switch over to Sales North, take a quick look here, and I'm seeing, okay, 110. All right, I'm starting to notice a theme here. Perhaps somebody had just put the same numbers into that particular product category and spread it all throughout the planned period. And maybe what we want to do is be a little bit more strategic with where we're having some of those purchases to control that inventory. And just to continue that example here, we're in Sales South, seeing that same 110 figure on a weekly basis. Now, I'm sure as many of you have different purchasing cycles, you might not see this flat purchase throughout the year. Just for the purposes of our demo, keeping things easy, we could manage it this way. However, it is very simple to manage product purchases on a weekly basis with different numbers. So what I'm going to do is go back to our sales east, where we saw a lot of that excess, that overweightness as it pertained to purchases. And I'm just going to go scroll to the right here and focus on that number. So one of the things I'm going to try to achieve here is see that by the end of the year, for our projections, we'd really like to bring this 144,163 number as our ending balance for this particular region and product category down a little bit. So what I'm going to attempt to do is, by adjusting our purchase units, we have a bunch of variable drivers in here. We should see this number reduce throughout the year. So going to the left, I see that we don't have a lot of weakness during the weeks. So we definitely have a lot of available inventory. And this is something somebody else might be curious to know as they're going through the year. We want to make sure that we don't dip too low in any given period. So here, what I might do is first, just to kind of test the waters, put in 100 for that particular period. And if you'd like, many people do in Excel, you just type into the periods. Now, I don't have that kind of time in my life, so what I'd like to do is sort of speed things up here. Adaptive has this nice little feature where I can just take a number, spread it through the rest of the year quite quickly like that, apply my change. And now on this sheet and throughout the system, we are now projecting a new purchase schedule for this particular region and for this particular product category. So now we're at 100. So if I scroll back to the right, what we're going to notice is our ending balance is going to continue to drop and go down a little bit there. So we're having those variable drivers bringing it down. So instead of being at approximately 2,400 excess units at the end of the year for this particular region, we're at 1,901. If I wanted to be a bit more aggressive, perhaps I can bring us either at or below what we previously were at in the prior year. So what I'll do here is going to bring this down to 80, spread this throughout the rest of the year. And just as quickly as that, we're able to adjust some of those assumptions that we have going on. So now scrolling back over, and now instead of being like somewhere in the hundreds, we're down to 52,671 for that ending inventory. That's one of the key numbers that I'm probably paying attention to here. But the other thing I'd like to know is, during our prime sales periods, that our inventory doesn't drop to an insufficient level. So I'm being cognizant of some of my thresholds. But even at this 80 purchase level, we're still not getting too low. So just a little bit of insight there from the analytics perspective of how we could go about integrating in some of our assumptions as it pertains to sales, having our rolling inventory guide those balances, and then on this sheet, having a very easy and manageable way to adjust those volumes by whatever either region or product category, wherever we're seeing those opportunities for enhancement. All right. So Loren, I'm not sure if you had any insights that you would like to add and provide in addition to some of what I've showed here.
Yeah, certainly. Yeah, thank you for this. Just wanted to point out, this is really showing what it means to have a comprehensive planning tool. So, on one screen here, you're seeing all the inputs from the decisions made on the sales and marketing, what the expected volume will be. You're seeing inputs from the financials in terms of cost, and then at the this is informing a particular purchasing decision around what level should we purchase at in terms of managing inventory. And then that information, of course, goes right back to warehousing. The rest of the, you can play out the whole scenario here, and you're seeing that over time without a lot of navigation, just sliding back and forth. And then as it takes place, you'll see those green actual numbers then, play out as week by week it goes by. And so you really have keen insights. I just wanted to point out, this is really a good insight as to, what does it mean to have a comprehensive plan? Everybody's on the same page, and decisions in one place is spread across the whole organization. And these purchasing decisions then flow to the full financials, income statement, balance sheet, cash flow, etc. Yeah, but back to you, Brian.
Thank you for that, Loren. All right. So for now, what I'd like to do is pivot back to one of our primary sales dashboard screens. So as we mentioned before, we're assuming here that marketing and sales has baked in their forecast with our assumptions as it pertains to how we're going to sell by channel, how we're going to sell by product category. So we've taken some steps to improve our projected inventory balances. Sell side has built in their plan based on what we can move at a certain price. Now, one of the things that we'd like to try to do here is see how we can go about focusing on and improving some of our margin. So with this demo, this fictitious company, we're seeing that the gross margin here is tracking as forecasted, slightly below 40%. Perhaps that's a threshold we'd like to try to address and see if we can move the dial, quite literally, to get that over the 40% mark. So now what I'm going to do is show you a way that within Adaptive, there's different tools to be able to, I showed you a little bit about the drill down on the dashboard. There are other features such as reports within Adaptive that can help provide some of that additional context when we want to see things in a bit more of a holistic view. So with this sort of simple report here, what we have is a tabular format of, okay, here are our regions, here are our product categories, and here is the express projected gross margin by each of those data segments. And just a little bit of report magic here, as everybody here I'm sure has used conditional formatting before. What I've done to kind of highlight areas of potential opportunity is said, okay, anything below 30% gross or projected gross margin may be an area where we'd like to drill in a little deeper to see if we might be able to affect some of those numbers, be able to move the dial and get our teams together to make those improvements. So one of the first things I'm noticing here, and again, assuming the role of the analyst, is our product categories A1 seem to be pretty consistently low. Now, perhaps this is like a legacy product that, hadn't, maybe it's kind of long in the years and the margin there isn't quite as good as it used to be. But what does kind of stand out is this other product category B2 here, tracking at 28.8%, where I'm seeing in other regions a little bit better performance there. So that's something that I think I'd like to drill into first, given some of the initial results that I'm seeing from this particular report. So now what I'll do is I'm going to pivot over to another sheet within Adaptive. And this is a little calculator tool that we've built in to kind of represent how we could go about isolating one particular component of the margin, the COGS here, and identifying if we made some adjustments in our assumptions, how we could assume a better potential gross margin with making just either small tweaks or larger tweaks, and then seeing how that fits into the overall comprehensive picture. So with this tool, this calculator, if you will, what it does is it evaluates margin based on region and by product category. And as you're seeing lots of little gray areas here, it means a lot of this is all just being calculated. And it's just a simple input at the top here that's going to start changing some of the figures. So let me help give a little context in terms of what this is doing. So the first line item here is the gross margin percentage. So this is currently what we're tracking at. Net revenue provided by sales and marketing on another sheet. They've already given those insights. So that's just coming into here. COGS less direct product costs. So what we're going to do here with this calculator assumption is we're going to try to hold those constant. And then basically what we're going to try to affect is if we wanted to improve margin, what would we have to change in terms of what we acquired those products for in order to achieve that margin? So basically what that amounts to is giving our purchasing team an opportunity to go back to vendors to potentially negotiate for a better price. So that's what you're actually seeing at the bottom of this calculator, the asking price being the historical price or the more recent price that we've been getting for that particular product category. So here with B2, we're seeing that $80. And then as we adjust the gross margin, you're going to start to see the discount percentage and the offer price start to move. So what this will do is saying, okay, so this is what we're currently at. If we move this margin percentage a bit, where could we be in terms of margin, but then also what kind of pressure would we have to put on the purchase side to be able to move that number to a more favorable position. So right now we're tracking at that 28.84% on the gross margin, again, under the 30% threshold. Ideally, we'd like to get the total percentage up there a bit. So what I'm going to do here is let's just get a little bit extreme. We'll move this up to maybe 40%. And then I'm going to break this back. So what this will do is push it into all the relevant periods for me. I'll click save. And then what you're seeing here is the dial move. So again, there's that original historical price that we've been getting for the product, $80. Now, if we wanted to assume that movement to 40% margin on this particular product category, what that means is we would have to approximately go back and get about a 26% discount on that piece that we've been purchasing. So that might be a little aggressive. Maybe 25 is a bit too high. So if I move this dial back a little bit, maybe to 35%, we'll see that discount percentage reduce a little bit, and maybe about a 15% cut would be more palatable for the particular vendor that we're getting this item from. So this just gives the opportunity to management to identify, okay, here's a potential place where we can go, make some adjustments, improve our gross margin on that one specific isolated area. But then what this will do is it will roll up to the entire comprehensive outlook for this projected planning period and help with those margin percentages. So going through this exercise, one could go to each of these different product categories and regions, make those adjustments. And then what we're looking to do is provide our purchasing team some guidance. So before I move ahead, Loren, I think you might have some additional thoughts here as well as it pertains to the margin calculator.
Yeah. No, thank you for this. And you might want to just zoom in a little bit on the numbers here. But what this here is showing is it's another example of where not only can you see, have a screen that would show, overall multiple inputs in different parts of the business, but can it be as targeted as supporting one business process where there's an executive that really needs to make some decisions about the needed gross margin to make the whole equation work, be able to put in those inputs, and then that decision is then disseminated out, and other parts of the organization then can respond to that. And again, do that from multiple different scenarios to say, if we did this, what would it mean? If we did this other thing, what would that mean? And then have the results of that calculated, communicated directly across. So you can imagine the phone call here that's happening from the executive to, let's say, purchasing, hey, we needed to, move up the gross margin. I know it's going to have an impact on your purchasing. Do you open this report? You're going to see, the results of that. Let's have a discussion about what you think is realistic around that. And I guess I'm getting ahead of myself with the demo. But at any rate, this is just a way of another way of seeing that embedding information in the business process in real time has real power.
Excellent. And yeah, just to reiterate that point that Loren had made, we often see that using this calculator like this that's embedded and integrated gives the opportunity to hold those meetings together in real time, see how micro adjustments in certain areas can affect the overall business. So having this tool kind of always integrated real-time information, getting everybody that information once can be quite powerful, the time to decision making, if you will. All right, so adjustments to this calculator here, quite useful tool for, like I mentioned, the management team to make those adjustments. What we can do then after this is provide some context for purchasing. So instead of coming back to the calculator and reviewing each one of these, we have a report here, which will, once updated, provide some context into, okay, we want to see some improvement in some of these product categories. So original asking prices, offer prices, purchase discount information. And this could be like a real-time report that purchasing looking at on a daily, weekly basis, where they need some context or some guidance from management as to what we're trying to achieve so that we're all rowing in the same direction. And just to kind of further that point, if product category B2 is something of a priority, and this is a report we know that the analysts are looking at, then we might say so I might say something, give a note to Loren. Loren, see if we can do better here. Click save, and then what we have is a report that we're operationally using real time. Everybody's coming into the system, and information can be in a single source of truth be shared so that we're giving context to the team. So a little bit of analysis here that provide those, company overview, that insight to how we can make those improvements. So what I'm going to do now is I'll just pivot back again to the sales dashboard screen just to quickly recap some of what we had done. So looking to put in our projections for sales, marketing, gave all that information as it pertains to channel and product. We started addressing a bit of our excess inventory issues on the other screen there. So I'm making improvements into our overall cash, and then attempting to move the dial as it pertains to gross margin. Now, perhaps this dial can move a little bit more if I got a bit more aggressive with some of those other figures, but that would be the exercise here that one could go through. I think that about wraps it up for me. Loren, do you have any final insights here before I close the screen?
For that, sorry, messed up on the mute button. Yeah, so just gives some good insights on how you can go from a dashboard in near real time, see the actual results, be able to analyze what's going on, make decisions, inform the overall organization, and then everybody's working with information inside of their own business process. And it is quite powerful in just changing that question from what's happened to what is happening and capturing that value decision making. So with that, I think we'll end the demo and go into another polling question just around timing. And just curious on what you're seeing in your planning process. How long does it take to create the annual plan? So the annual plan is, as you go through and you make that plan, slash guardrails for the organization going forward. How do we think it's going to play out? If you take that same process and you say, well, what if we were going to execute that on a quarterly basis? It's really kind of driven by, well, how long does it take on the annual basis? And is that effort worth it to get into, a more frequent planning process? And what we have found is when you get into these, comprehensive planning tools, what happens is it speeds the process up dramatically, kind of like what you're seeing in the demo, where one person putting in one result will then inform the whole organization so it can move right along. And then if you're making decisions on a quarterly basis, like, okay, we had a plan, but it turned out to be, the first quarter turned out this way. Do we need to make some adjusting decisions, and can we replan for that? Okay, so looks like we have some results here to take a look at. So there's few people are moving very, very quickly. So congratulations on that. The typical thing that we see is kind of what we here is between 1 and 2 months. It does trend in with our client base, into the 2-month and beyond. Usually it's kind of when we start engaging with them, and then it's you put in this automation, then it swings, kind of way over to the other side as well. So, well north of 60% is taking longer than 2 months. There's another statistic out there, by the way, that, once you have a plan and it's, 3-4 months old, that, 60% of the organizations, there's a material difference from what is actually happening on the ground. So with that in mind, that really drives us to rolling forecast. And this is something where there is a lot of business value in being this in tune with your numbers and be able to make, adjusting decisions that are known across the organization. So the top of this is pointing to a typical annual plan. You pick it up, you make a plan for the entire year, and then you play it out. And then when you get to the end of that year, you plan for the next year. So you kind of have this planning cliff out there, if you will. It's not necessarily reacting to actuals as they're coming in. And then the one on the bottom is saying, what would it be like if you had rolling forecasts? What you're asking your people to do is on a monthly or quarterly basis to plan what should be doing this next month, what would be the thing that would be, the safe for the organization and get us to the best position, the best value for the organization the next month. But then also look a year ahead and at the same time say, this time next year, where we would like to be. When you get to the end of the year, you're going to find you already have the makings of an annual plan at that point. and it'll be much more in tune with where the organization's heading and really react to the strategic direction. So this forward-looking planning, not only does it help you get to that plan faster, but it really engages the organization at a very different level in terms of planning and looking forward. Now, I mentioned there, just kind of in passing, a monthly plan, and that may seem, or monthly reforecast, that may seem unrealistic. We encourage our clients to get to a quarterly reforecast, and we're surprised on how many say that was easy enough. We really want to drive engagement by doing that on a monthly basis and have everybody tweak their numbers and stay in tune with them. Another thing that we've covered here is having multiple different versions and how that drives insights. So you can have different versions from a couple of different perspectives. One could be we're at the beginning of a new year, we're doing our annual plan, and there's a couple of different ways we could go about this. And so you'd have one scenario be one way you could go about it, strategic direction, another scenario be a different way that you could go about it. And then play those out. So everybody would see them, take the two different scenarios, put their piece into it, and see comprehensive the plan. How does that play out? Bottom line, balance sheet, cash flow, all the rest of it. Seeing those side by side is just super powerful. So you have that visual effect of saying, okay, here's our plan, here's our forecast, here's the actuals, how it's really playing out, and then what different decisions should we be making to optimize where we're at in the business environment that we're actually in. So, having that very real-time look into how things are playing out is really a key driver into changing that question to how are things actually going. So just to wrap things up a bit, wanted to go through and review some of the things we've talked about in terms of automated planning. What are the benefits of going through and having an automated planning solution? What is the ROI from that? So it really does power that rolling forecast capability. So the ability of having a solution do all the work for you in terms of reporting what is the budgets to actuals, have that fully automated, the dissemination of the reports fully automated. And then with that amount of information, during the period, and you can still make decisions, that ends up deriving what this rolling forecast capability can do for you. Also drives the efficiency in budgeting. So for everybody that's worked in spreadsheets, that's probably everybody on this call, that it's, a spreadsheet's a super powerful tool. But as you grow in complexity and you grow in different scenarios, and then you put in channels and product categories, so all of a sudden those spreadsheets just explode in terms of complexity and the ability to make sure that they're actually calculating accurately. So a solution like this guides people through, keeps everything on the rails, and informs the whole organization. And then just automating that consolidation at multiple levels. Probably many of your organizations are more complex than a single entity, and getting consolidated numbers across the whole organization, but yet being able to see deep into any particular organization is a super powerful way of just keeping your finger on the pulse of what's happening. You saw a bit of the reporting tools that Brian was using. So there's that's just tip of the iceberg. There's a ton that you can do inside of these tools from that perspective. And then looking at not only operational, but also full financial metrics. So you have a good overview and good context as to what the numbers really mean. And then again, just that what if scenario, be able to very quickly go through these what if scenarios and see what if we did this, and have a different version that would compare to where you're actually at. So one last polling question here. It's just a question around the visibility to your plan, and as actuals come in, how often do your department managers see updated comparisons between your actual business results and what your plan and your forecast are. Yeah, this is usually driven by, as your different departments are getting more and more engaged in this planning process, this frequency increases, and it really helps in finding value when you can make a decision that affects what's really happening on the ground at the time. And so what we tend to see is, as we go through and are implementing it, and there's champions in the system, and they're looking more frequently, they're seeing value, they're getting success, and that's driving value or driving engagement with other parts of the organization as well. And Frank, I know you might see some of this in your client base as well. Yeah, you're on mute.
Find that interesting, as we're looking at the timing and you're thinking, how continuously, yet the discussion earlier talked about, it may take a couple months to get through planning. So, how many times can you do it if it's a couple months? You certainly can't be doing it weekly. So one of the questions I saw in the chat room that maybe would be helpful while people are putting their results in is to talk a little bit about, the question was, how long does it take? What's the timeline to implement, the Workday tool? And I know it, of course, it's going to be different for each situation, but if you can give a sort of a range, Loren, that'd be helpful.
Yeah. So what we typically see is a 12 to 16 week implementation time frame. And I'll just flip to the results here while we're going through this. So so looking at it monthly, for the most part, but getting back to the implementation time frame, 12 to 16 week is the common, so somewhere between 3 and 4 months. However, during that time, you will find that one of the first things that happens is you attach it onto you integrate it with your current systems, and within a few weeks, you're seeing your actual results come in. You're using the actual reporting, and you're getting value from the system within just a few weeks, and then incrementally as you implement the rest of the system, it spreads out across the organization, and everybody's getting that benefit. So, nuanced answer: you start to get benefit right away. Full benefits come in 3 to 4 months. So hopefully that helps. So this top answer here, continuously in a planning system, that's really what happens when you're in these automated planning tools. And then when you're in the world of spreadsheets and the like, it looks like there's some people that are really on their game, nearly 10% are seeing it weekly, with the vast majority on a monthly basis. Now, how's it going this month? So as we've talked through this, I keep talking about engagement. So I just wanted to close here with a slide that talks about what does that mean to be engaged, and how does that really play out across the organization. So starting on the left there, these automated planning tools are really about being responsive when things are happening. So it's that top answer to the last question, continuously looking at the difference because you're in a planning tool. When you have that, you can plan for everything and really be on your game. If you're doing that, then you're adaptable, and you're adaptable down to the front line, meaning you're building a fluid organization. People are planning, they're looking at the results, they're kind of on their toes, they're aware of the business environment and able to make decisions in the decision-making window and be very, very proactive about that. When you have a team that's doing that, you'll find it'll really lead to being collaborative. You're in a common tool, your results of one department are flowing to the other department. There's targeted information that's being shared and is giving you that comprehensive plan on an ongoing basis. That will drive collaboration. That collaboration, again, drives to better decision making. When you have that, you'll find that your team becomes much more empowered. And then with their empowered, then they're in control. And so that's really a lively organization when you have that. That's something that can be driven with an automated planning solution. So I just want to thank you for your time here. Thank you for joining. It'd be great to have a conversation. Here's some contact here, but again, just want to thank you for your time.
Thank you, Loren, Frank, and Brian, for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us. We hope you'll join us again next time.